Welcome back to another episode of the Disciplined Trader Collection podcast, brought to you by Bell's Forex Audio Works, where we transform complexity into clarity and volatility into opportunity. I'm your host, Isabel Maria, a fellow trader who's spent more than a decade studying market behavior, testing systems, and navigating the fine line between strategy and execution. Today, we're talking about something every trader has heard of, but few truly master: backtesting. It's one of those words that sounds technical, maybe even boring at first, but it's the quiet, behind-the-scenes engine that turns theory into performance. Done right, backtesting can completely transform your trading, turning random decisions into calculated precision. So let's unpack it. Backtesting is like running a simulation. You take your trading strategy, feed it into historical data, and see how it would have performed in the past. It's not about predicting the future, it's about understanding the past so you can make better decisions going forward. Think of it as a flight simulator for traders, a place where you can test, crash, rebuild, and refine, without losing a single dollar of real capital. What makes backtesting so powerful is that it replaces guesswork with evidence. Instead of thinking, "I feel like this setup works," you can say, "I know this setup has a 62% win rate with an average risk-to-reward ratio of 1 to 2.3 over the last 10 years of data." That's not intuition, that's statistical confidence. As traders, we're emotional creatures. Even the best of us can be swayed by fear and greed. But backtesting cuts through that noise. It gives you something solid to stand on: data. And when you trade based on data instead of emotion, your decisions become sharper, your confidence stronger, and your discipline much easier to maintain. Let me illustrate this with a quick story. A few years ago, I mentored a trader named Alex, a bright, motivated guy, but completely frustrated. He kept hopping from one strategy to another, convinced that each new setup would finally be the one. The problem wasn't his ideas, it was that he never tested them properly. So I challenged him to take one simple moving average crossover strategy, just the 50-day and 200-day, and backtested over 15 years of market data. At first, he resisted. "That'll take forever," he said. But once he dove in, something clicked. He discovered that his strategy performed well in trending markets but fell apart during sideways ranges. That insight alone changed everything. He learned to filter out trades when volatility dropped below a certain threshold, dramatically improving his win rate. That's the beauty of backtesting. It doesn't just tell you if something works. It tells you when it works, why it works, and how to make it work better. Now, for backtesting to be meaningful, you've got to do it right. You start by defining your strategy, and I mean crystal clear. What's your entry? Your exit? Your stop-loss and take-profit rules? What time frames are you trading? Are you including transaction costs, spreads, and slippage? Every detail matters. Because if your backtest doesn't reflect the real world, your results will be fiction. Once you've got your rules, you need enough historical data to test them properly. A common mistake traders make is testing on too short a time frame, say, 1 or 2 years of data, and assuming the results will hold. But markets go through cycles: bull runs, bear markets, low volatility phases, high volatility spikes. You've got to see how your strategy performs across all those environments, and when you get your results, pay attention to the key metrics: total return, drawdown, win rate, profit factor, and risk-to-reward ratio. These numbers are your report card. If your strategy earns a 60% win rate but the losing trades are twice as large as the winners, you've got work to do. If your max drawdown is 40%, maybe it's not suitable for your risk tolerance. Backtesting is not about finding perfection, it's about finding balance. But, and this is a big one, backtesting has traps. One of the biggest is what we call curve fitting. It's when you tweak your system so much that it performs brilliantly in the past, but fails miserably in the future. You know the saying, past performance is not indicative of future results. Curve fitting is the reason why. If your backtest is too good to be true, it probably is. Another danger is look-ahead bias, accidentally using data that wouldn't have been available at the time of the trade. It's like giving yourself insider knowledge after the fact. Even a tiny error like that can make your backtest completely unreliable, and don't forget transaction costs and slippage. Ignoring those can turn a profitable-looking strategy into a money-losing one in real life. The goal is realism, to make your backtest mirror the conditions of live trading as closely as possible. Now, let's talk about integrating backtesting into your regular routine, because this shouldn't be a one-time thing. The markets evolve, conditions shift, correlations break down. What worked 2 years ago might not work today. That's why ongoing backtesting, monthly, quarterly, or even after every major market shift, keeps your strategy sharp and relevant. It's also incredibly useful when paired with forward testing or paper trading. Once your strategy looks good on paper, test it live, with no real money, in current market conditions. If the results hold up, that's when you know you've got something robust. There's another layer of benefit here that most traders overlook. Backtesting doesn't just improve your strategy, it improves you. It builds discipline, patience, and analytical thinking. It shifts your mindset from guessing to testing, from hoping to knowing. You stop chasing the next hot setup and start refining the one you have. That's how real traders are made, not through luck, but through methodical repetition and review, and the documentation you create along the way. Your backtesting records become your trading journal. They show your evolution, your mistakes, your breakthroughs. Over time, you'll be able to look back and see how your thinking matured, how your early setups evolved into structured systems. That's how confidence grows, through evidence, not ego. Now, backtesting isn't glamorous. It's not the part of trading you post on social media. But it's the foundation. And without a solid foundation, no strategy, no matter how clever, can stand. As the great trader Ed Seykota once said, the elements of good trading are cutting losses, and cutting losses. And the only way to know where those losses might come from, before they hit your account, is through rigorous testing. So here's my question for you, and I'd love to hear your answer in the comments down below. Have you ever actually backtested your strategy from start to finish? If not, what's stopping you? Is it time, tools, or maybe fear of what you'll find? Because once you see your results in black and white, you gain something priceless: clarity. You'll know what works, what doesn't, and exactly where to focus your improvement. Until next time, stay disciplined, stay data-driven, and remember, your best trades start long before you click buy.
Thank you for listening to The Disciplined Trader, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!